All boils down to a financial plan. The U.S. government needs a financial plan, Cory.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me.
Cory, humble brag here. Retiring Right has become a #1 bestseller.
Pretty cool, Jake.
Credit to me, Cory. Credit to me, it's happened. If you're listening or watching to Upticks, you can go out to Amazon.com, pick up your copy of Retiring Right, Smart Steps for Exiting Corporate America. Cory, I've got a Kindle version, I've got paperback, and I've got hardback. It's all out there. Whatever your preference is, check it out. And you know what's pretty cool is that I had a client buy it and give me feedback already, and he really liked it. So, you know, I'm really exposed right now because I basically put myself out there.
You are.
And I'm excited, though. I'm excited for our clients to read it. And again, if you think it's any good, a 5-star rating on Amazon would also be greatly appreciated. The whole purpose of writing that book, Cory, was to enhance financial literacy and hopefully get 18 years of my experience out there at scale.
The same reason we do the show, right?
That's right. Same reason for Upticks. Same reason we're spending time doing this is we're just trying to help people, and hopefully that'll do some of that out there. Do you have anything new?
Again, the #1's pretty cool, especially seeing it happen so quick.
It was quick. It was quick. It's very cool. Very humbled about that. Very excited about it. And so thank you for that, and thank you to all of our listeners out there who are buying copies. They're flying off the shelves, Cory. Flying off the shelves.
Can't keep them in stock. I like it.
That's right. That's right. Do you have anything new? You want to talk about anything sports related or anything going on?
No, not too much new there. I have not really been too dialed into sports. I've actually probably followed golf a little bit more than anything else this year, Jake, interestingly enough.
You know, you don't watch that show PTI, do you?
I don't.
I'm a huge PTI guy. So recently they talked about the PGA Tour and LIV and how it's been a year since they announced they were going to merge.
Right.
And they haven't merged. And so I'm curious, since you said you've been following golf, do you think they need to merge? What do you think needs to happen here?
I don't really know. I don't. I've been following more of the individual tournaments. I don't know too much about everything that happens behind the scenes, other than, like, as a casual observer, the PGA and LIV were such at odds with each other until they decided that they were going to merge. And like you said, a year later, here we are. Hasn't happened. I don't. Do you think it needs to be combined? Is that necessary? I don't know. I guess I don't really have the right perspective.
These guys make good points. I'm a huge fan of the show, as you know. I've been watching it since I was in college. I took a huge break. I'd stopped watching it, and now I'm recording it, Cory. And sometimes when I go home at night, I watch it. It's only 30 minutes. Mm-hmm. These guys are great, though. It's Tony Kornheiser, and do you know the other guy?
Michael
Wilbon.
They've done it forever too, which, you know, credit to them.
Yes, I was in college. They've been doing it a long time. So it's obviously good. They wouldn't have kept it on the air, I think.
What was their take?
Well, I agree with a lot of what they said. And basically, the problem is, Cory, these regular PGA Tour events this year, at least, as of the recording of this show, have been full of a lot of people that you don't know who they are. So the stars are there, but they're not like it used to be. And the problem with LIV, besides the political issues I have with it, the problem with LIV as just a golf tour, I don't like that there's no cut. I don't like to see these guys wearing shorts. I don't like the shotgun start. I don't like the team. I don't like anything about the format. The only thing LIV has is they have a handful of really good golfers. A lot of their golfers aren't that good on there. They're stars, but they're kind of older, and they're not the people that would be. But they have a handful of really, really good golfers. So that's the only thing that I miss about having the tour. Now, they brought up a good point. I don't know this as much because I haven't been around sports as long as these guys have. but they said that basically there's a threat. I guess boxing used to be the thing, and boxing got fragmented, and now it's not a thing.
Yeah.
I think tennis used to be a thing. I didn't realize. This is a really good point. You're a tennis guy. Tennis, there's like it's only about the 4 majors. Nobody else cares about any other tennis.
Pretty much.
And their argument is that golf is at risk of becoming that, where the only thing people care about are the 4 majors, and then nobody cares about anything else, which I think would be horrible for golf. Because think about it. Do you watch other tennis tournaments besides the majors?
I do.
Do you?
But I'll watch specific players. Like I'll literally have like alerts set up for when specific people are playing, so I'll tune into their matches.
Yeah.
So that's it.
So that's my fear. I would hate to see that happen in golf, and it could. So anyways, this isn't a sports show. Let's get on today's topics.
Good idea.
All right, Cory, kick us off.
Capital gains tax hits more home sellers.
Yeah. So many people don't know this, but if you sell your home, Cory, and you make enough money on it, you are subject to taxes. Okay. Now, again, the topic of this show is not to give you tax advice, certainly. However, I did just want to shed a light on this, that roughly 8% of 2023 home sales brought windfalls over and the limit's $500,000 for couples to be exempt from capital gains taxes. And Cory, that's more than double the share in 2019. And this is according to CoreLogic, which is basically a real estate data firm. Now, there's some things that you can do though. So if you bought your home for $400,000 and you're going to sell it for over $900,000 and you're married, you may be subject to some taxes, but there's some things that you can do that I thought was a good part of this article is that number one is to keep your receipts on any home improvement costs. Not maintenance. So if you have to fix a toilet, that doesn't count. But things like a roof, or you put a swimming pool in, you can add that to your cost basis. So let's say, Cory, you bought a house for $400,000 and you put a roof and a pool in, and all that costs you $100,000. Well, now your cost basis is what it's called is $500,000, and if you sell it for $900,000, now you in this theoretical example, you would know, oh, no capital gains.
Yep.
So I think that's just the takeaway. If that you buy a house or are looking to capitalize on the sale of your house at one day, make sure you keep those home improvement receipts because you don't want to pay taxes if you don't have to. So I thought this was a good important article. What are your thoughts on this?
That's great. I think that is smart, sound considerations for people. And shame on me, Jake. I have known since I bought my house in 2020, I have known for years that I need to do exactly this, and I still haven't done it. But I do know that I need to keep track because I at least know where I can find the data, but I need to populate it all into one place and have it because of exactly this reason.
Yes. Yeah, exactly. Especially with you bought your house, I feel like
recent enough that it should be easy for me to keep track of. But
what is that?
I said I bought it recently enough that now is the time for me to go back and pull that data. Go on.
Yeah, I wasn't going there with that, which is great, which is right. What I was going is that you bought your house at a really good price. Hasn't your house appreciated a lot?
Yeah, pretty meaningfully it has since we bought it 4 years ago.
So that's why it's important for you though, right? It's like, now the house I bought, I didn't make that much money on it, so it didn't really matter. But I'm hopeful that this is the one I sold. I'm hopeful the one I just bought will appreciate. So you're right, I got to be doing this too. I wonder if home interior, because I've spent I don't think it does though, right? Maybe the wallpaper and the paint.
I think it's a good question for an accountant.
Yeah,
but, it is.
I think it is. But
that
obviously
home improvement piece is the key.
Yes, yeah, because you have to be careful of that. But I would think paint, again, I'm not an accountant, so I would check with your accountant on that. But I would think paint might qualify, but I don't think, obviously, furniture doesn't. So anyways, I thought it was good. It's important, though. So remember that you could pay taxes on selling your house. So keep those receipts on home improvement items, especially the big ones.
Yep, keep track of the investments. Good.
All right, good. Let's go on to the next one, Cory. Buy something boring.
Yes, perfect timing after the article we just covered. So this is a real short blog post from our friend Carl Richards from LinkedIn, Jake. So I'm just going to read this here.
Okay.
Ever notice how retired people love to say that the house they lived in for 30 years was the best investment they ever made? Speaking purely in terms of financial returns, they're probably wrong. For the last 120 years, housing prices have barely kept pace with inflation. but they're probably right, just not for the reason that you think. For many retired folks, the home they think of so fondly may be the only investment that they have ever actually held for 30 full years. According to the research firm Dalbar, the average investor holds onto their mutual fund for just over 3 years. The power of compound interest, even if the return is slightly more than inflation, is amazing, but only if you allow it time to compound. In the end, the best investment conversation isn't about the relative merits of real estate, it's about behavior. So ask yourself 30 years from now, what will be your best investment?
All right, bravo, Carl. You're right, Cory. How many times have you heard this from clients? I made a ton of money on my house, but then when we do the math, it's like, well, you average 3% a year on that.
Yeah, it's all relative. Yeah, exactly.
Yeah.
Yes.
I love it, though. The key, the secret ingredient for all of our listeners and viewers out there. And by the way, thank you to all our listeners and viewers. Our subscriber count continues to grow. Please like and share our content. Subscribe. We are recording Upticks today to enhance financial literacy. The key, though, Cory, is behavior. That is the secret sauce to investing, is not trying to time the market, not getting scared, not getting greedy. And you're right. Homes typically are more disruptive when you buy and sell them, unless you're an investor, right? But if you're living in your home, nobody wants to move every 3 years. I don't. Do you?
No.
So
I don't ever want to move again.
So
yes,
people, again, they get it right for the wrong reason, that yes, your house is appreciated because you haven't sold it. Now, this is what's important, though. I think, though, that Carl is missing a little bit in this article, is that a bad investment still is not worth holding on to. So it does pay to make sure that your account is getting rebalanced. If you need to buy and sell stocks, which is what we do for our clients, that's happening. The key component, though, Cory, is that we're not getting out of stocks and going to cash, and we're not going all in. And so we're not really changing the allocation unless something has changed with the plan. We are staying invested. And I think that's what he was trying to point out here, because just like a mutual fund, they're trading in there also. So again, the key is to stay invested, manage your behavior, and let compound interest work for you and your family. And hopefully that'll help enhance your financial plan. Good one.
Yes. Patience and discipline.
Yeah, it's good. Good.
All right, Jake. Retirees, here is how to be smart about bonds.
Great article, Cory. Credit to Barron's. They talked about how it's better, the way I read the article at least, to buy individual bonds versus a product. It also says not to put too much money in these high yield savings accounts. And the reason is, if and when rates drop, you could or will lose out on interest that you could have locked in if you bought a bond that matures in 5 years or 10 years or whatever. So the point of this article, and again, the show is not advice, the way we do it for our clients is we buy individual bonds, we ladder the maturities, and then we do implement a high yield savings account for their very short-term cash or money they don't want to invest. And anything you want to invest, for the bond allocation, we don't use index funds, exchange traded funds, mutual funds. We just go out there and we buy the bond itself. When we buy a bond from XYZ company that's paying 5 or 6% and it's going to mature in 7 years, then our client knows, as long as that company stays in business and can satisfy their debt obligation, that they're going to get their money back in 7 years, and in between now and then they're going to get 6% or whatever it's paying. That's the way we prefer to manage bonds for our clients, and I'm glad that Barron's saw eye to eye with us on that. Any other thoughts on bonds and smart ways to do it, Cory?
Can you just expand briefly here, Jake, on if someone is looking at a bond that matures in 5 years, let's say it's paying 5%, or they're looking at a bond fund that has an average maturity of 5 years and it's paying 5% too. Can you just explain a little bit more about the difference between buying the fund versus, and what that really means for somebody who's actually investing the money?
Of course, yeah, and I'm glad you brought that up. So the big difference with the fund versus the individual bond is when you buy into a fund, you're giving up control. Meaning your advisor doesn't have control, you don't have control. So what happens is, if that fund is faced with many redemptions, meaning other people want to sell that fund for whatever reason, they may be forced to sell your bond that's paying you 5% prior to maturity. And so when you do that, you don't really have a bond. You own shares of a fund that has bonds, but you're not really controlling that date. Also, Cory, there are fees associated with these funds on top of your advisor fee. So if you're paying an advisor fee and your advisor's putting you in a bond fund, you're paying two fees to own one bond or many bonds. But to own a bond, you don't need to be doing that. So that's why we don't like it. You give up control. Also, again, interest rates can fluctuate up and down, as we all know. So will that bond fund price. And again, there is no maturity date with that bond fund. So there's a lot of reasons we see not to buy bond funds. I guess in certain circumstances, they may be appropriate for individuals. Again, the point of this show is not advice. It's to enhance financial literacy. So hopefully that educates people a little bit more the makeup of a bond fund. I think a person that a bond fund may be suitable for is maybe you have $100 or $500 and you can't go buy a bunch of different bonds yourself because you still don't have enough money, but you want some bond exposure. Again, I still don't like doing it though. I still wouldn't probably do it personally, but that doesn't mean that it might not make sense for somebody else. So does that answer your question or your thought or what you want me to talk about there?
It does. And that's really interesting though, because we've commented in a few of the articles we've covered today about investor behavior and how important that is. That the question that, or really what I'm hearing when you explain this, Jake, and I know this, of course, but when you're allocating money to that fund, it's like, do I want the performance of my investments to be driven by other investors' behavior?
Right. And another money manager who doesn't even know you.
Right.
So not as that other investors driving that money manager, but at least our clients know that we literally have an internal team that are making those bond buying decisions. And you know what? The client can pick up the phone and talk to that team, which you're not always going to get that with a mutual fund.
For sure. Good.
So,
okay.
Good. All right, perfect. Let's go on to the next one. With the U.S. election just 5 months away, America's next tax plan is shaping up. Long title there, Cory.
I know. And I'm not going to read all of this here, but I want to share the highlights and just give a little context and see if you have any thoughts around this also, Jake. So one of the country's most heavily debated topics, of course, is taxes. And this tidbit that I'm sharing from here today is actually from a newsletter that a client sent me a few weeks ago, just kind of looking for my perspective on it. So I just wanted to kind of cover this and share it. And it really was highlighting, obviously, depending upon who wins the election in November of 2024, that there will be an impact, presumably on tax policy, because the Tax Cuts and Jobs Act is set to expire at the end of 2025. To make a long story short, the narrative, at least in this piece, was if the Republican Party wins, they've pledged to make the Tax Cuts and Jobs Act permanent, which would keep taxes lower and it would increase the deficit in our country by $4.6 trillion over 10 years, exacerbating the debt problem in the United States, according to the Congressional Budget Office. The flip side is that if the Democratic Party wins, the sequel to the Tax Cuts and Jobs Act could look a lot different. And they're suggesting that the rates could revert back to where they were before the Tax Cuts and Jobs Act went in place. There's a memo that's been circulated by the administration that suggests higher corporate tax rates, levies targeting billionaires, so on and so forth. So with all of this being said, though, what I find very interesting in all of this, Jake, and what I would love to hear your opinion on is government tax revenue and income is one part of the equation as far as the deficit in our country, but spending is the other part. And it seems to me that both parties keep the voting public focused on how much of their income or assets will or won't be taxed. But that just feels disingenuous to discuss if how much tax revenue is collected doesn't have a real impact on how much money the government spends, because we've seen the deficit get exacerbated as well. So I guess my point is, I would love to know as a voting taxpayer, right, if the Republican Party is going to permanently reduce taxes, I would love to know how they're going to reduce spending so it doesn't increase the deficit. And just conversely, I would love to know if the Democratic Party was going to charge a lot more by the way of taxes, how they're going to use that money to improve the fiscal situation in our country if ultimately the taxpayers are the one footing the bill. But I don't expect either party to talk about either of those things between now and November. But I'm just interested, Jake, in your perspective on this conversation about taxes and what's going to happen, and also understanding that the way that government spending influences the deficit is just as big of a part of the equation as how much revenue comes in.
Yeah, thank you. And thank you for the listener or the client who sent that to you. So You're right. This all boils down to a financial plan. The U.S. government needs a financial plan, Corey. That's what
Yep.
needs to happen. And so
Yep.
I want to hear the politician that says we're going to cut taxes and cut spending,
Correct.
or keep taxes the same and cut spending. You're right. If we're so concerned about having a balanced budget, which is a whole other topic, because maybe that doesn't matter. Maybe it doesn't matter. I think it should, but maybe it doesn't. So I think you're right. I think cutting things, though, is harder to talk about pre-election because it might be harder to get elected. I think, though, you're right. You're 100% right. A really smart person would be talking about both. This is the tax rates that we need. These are the things we need to cut to get our budget in shape. Don't you think that person would win the election if they could cleanly, in English, simplify it and say, this is what the tax code needs to do. This is how much we need to cut. This is what I plan to cut. And that's how we're going to get to a balanced budget. Don't you think the American public would celebrate that? Republican, Democrat, Independent, I don't care who you are.
I think they would. I think that, actually, you know what? I know they would, Jake. I am as confident as I can be that they would be. They would celebrate that. I would love that.
I've said this before. This country lacks leadership. We lack leadership. And I don't understand why we can't get somebody to step up and start leading this country. That it's just, there's so many clients I talk to, Corey, that we always agree, whether they're Republican or Democrat, we agree that it's very simple, that some simple things need to be done. You know, you need to do the right thing, say the right thing, be the right person. And I just don't understand it. It's gotten so polarized and backwards that, and I get it. I guess somebody that's in the middle never wins, but I don't understand why. I wish that we could have a leader step up and just make it simple, clean it up, and bring some patriotism back. You know, the Olympics are this year. Wouldn't that be great to have somebody that was getting around that instead of pulling people apart? I don't know. It's a tough one. I'm not going to do it. I'm not going to do it. So I can comment on it as much as I want, but if you're not willing to take action, all I can do is vote. What'd you say?
I said, maybe I'll do it.
There you go, Cory. Cory Bittner
I'm almost
for president.
old enough. I'm almost old enough now. But yeah, again, and my point is not to, look, everybody has a lot of different opinions, especially in the world today around the political climate. My point is just simply the fact that I'm like, you know what? Are we going to go into the election under the assumption that one of these parties cares about fiscal conservatism and and a balanced budget? I don't think so.
I don't think
because it's clear to me after watching different parties and different presidents the last several years that the government's going to spend money the way that they want to, for better or for worse.
Right. I don't think we're going to solve that one.
Don't get caught up in all of the, yeah, exactly. Don't get caught up in the, somebody's going to tax 90% of your income or this or that. That's all just driven to get someone to vote a certain way.
Right. All right, let's move on. That's not political.
Good idea. So the rules for RMDs are complicated. They have changed yet again.
Yeah, so RMD, Corey, stands for Required Minimum Distribution. This is something that you need to do based on if you've inherited a retirement account potentially, or once you reach a certain age. I don't want to go into too much of the details here. The point is you need to sit down with a financial planner on our team to go over your specific situation because there's a lot going on. The current age for somebody is age 73 when they are going to have to start taking required minimum distributions from an IRA, or 75. It's all based when we're born. You may also be able to donate up to $105,000 of your required minimum distribution to a qualified charity. And like I talked about, inherited RMDs have their own rules. And currently accounts inherited need to be emptied in 10 years, with some subject to annual RMDs, although the IRS, Corey, nice and confusing, has waived that in recent years. The bottom line is let's meet and discuss if you're approaching your 70s or if you have an inherited retirement account. We need to meet to make sure your plan is set up according to the rules, because there are some harsh penalties if you don't take your RMD. And so I'm glad the article shed some light again on required minimum distributions, because it can be complicated. And this is what's actually really complicated, Corey. If you have multiple IRAs at different places, you can't just take it from one. You could take it from one, but it has to satisfy all of them. So it's another case to consolidate your assets at one place to simplify it. But if you've got 3 or 4 IRAs, then you're going to have to make sure what you know your total required minimum distribution amount is, and make sure that gets satisfied either all from one account or from each individual account. So there's a lot of nuance going on there. It's a case to hire a financial advisor like us to help you with these conversations. And again, the really neat thing is our financial planning software knows what every client's specific age is and when those requirements are going to hit, so we can plan accordingly and help you do tax planning around all of that. Any other thoughts on that, Cory?
That is nice and confusing. How many times has it changed in the last 5 years? You painted it exactly right. I was thinking about how an inherited IRA from a spouse versus an inherited IRA from a parent have different rules associated with them now too. So yes, I think that you have absolutely, and the article makes the case for why it's important to get it right.
Yeah, it used to be 70 and a half. And so again, this is again the government fiddling with the rules, and I don't know why, but they do it. And maybe some of it's to help, hopefully, the American population. The key, though, is you want to work with a chartered retirement planning counselor, such as myself or Cory, because this is what we're in every day. We are in talking about these rule changes, discussing them with our financial planners, and most importantly, we're meeting with clients to go over it. So again, it's just something that you need to be aware of. If you're younger than this and you've got a parent or a family member or a friend in their 70s, feel free to refer them to us. We're happy to meet with them to go over their required minimum distributions. And you can simply email Luke at falconwealthadvisors.com, and Luke will make sure a meeting gets set up with either myself or Cory. All right, Cory, I think it's a good place to wrap up today's episode. Do you have any parting comments as we close out today's show?
No, Jake, I think that the only parting comment actually that I would share is get your copy of Retiring Right. Jake has opened the door, right? Made yourself vulnerable. Like you said, you put yourself out there. I think that's good. And I know you, Jake, well enough that the feedback is what you're looking for and what you want.
I'll take
and
any
I know
and all
you put
feedback.
in the time and energy for a reason to try to help.
Right. I'll take any and all feedback. I can handle it. I'm tough. And again, I did this to enhance financial literacy. It is 18 years worth of knowledge. It's thousands of meetings, all in a 150-page book, Cory. Now, again, I didn't go into all the nuance, but what my point of the book was is to serve as a guide. And hopefully I have written down things that maybe you or your family or your loved ones have not thought of yet. That's why I did the book, because I just wanted to hit on a lot of things that maybe you haven't talked about with somebody or haven't thought about. And that's the whole point of it. So I just want to serve as a loose guide to say, hey, you should be looking at all these things to retire right. That's what I did.
Yeah, that's great. And the experience from doing it for that long.
Thousands of meetings.
It's invaluable.
Thousands of meetings about retirement, and I love it. And I'll still keep doing it today. And that's why I put it in the book.
Excellent.
Well, thank you, Cory. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.